Hey, what is going on, guys? If you're new to the channel, welcome. My name is Nick, and today we're going to be talking about the top 5 high-yielding dividend stocks to buy in 2020. And before getting into this video, I just wanted to share that my channel just recently got monetized, which is why you may have seen an ad before this video. And I wanted to thank you guys so much for helping me achieve this in a period of only 8 months. It's been an incredible journey to date, and I realize that I'm so fortunate to have a fan base this big and supportive of me. But I'm even more excited to continue producing value-added content for all of you guys over the next coming months and years. And with that said, let's jump right back into the video. Now, given the huge growth in the stock market recently, in the beginning of 2020, it's been incredibly hard for value investors like myself to try and find undervalued companies. So that's why I'm making this video about dividend stocks and trying to focus more towards dividend investing in the start of this year. In fact, with a little bit of digging, I was not only able to find good dividend paying stocks, but also those providing pretty good value right now too. This is super important because buying a great dividend stock on a discount allows you to take advantage of that higher starting yield, which will eventually translate to more passive income that you receive every single month. Guys, it's really just a beautiful thing, so I hope this video provides you some value, and make sure to stay until the end because I did save some of the best dividend stocks for last. So if you do enjoy this video, make sure to gently tap that like button for me because I did put in a ton of effort trying to research this video and find some undervalued dividend stocks, so I'd really appreciate it. Also, if you are new here, definitely consider subscribing down below for more content on personal finance, investing, and business in the near future. So with that said, let's jump into the top 5 high-yielding dividend stocks to buy in early 2020. Alrighty guys, starting out with stock number 1 today, and that is the Exxon Mobil Corporation with ticker symbol XOM. Now, if I were to rank all of the different dividend stocks that I talk about today, this would probably land right in the middle in terms of risk that you're taking. Now, Exxon Mobil is probably a company that a lot of us have heard of, and it is the leading and probably most well-diversified oil and gas producer in the world. In fact, the company owns and operates a lot of upstream production plants, refineries, lube plants, chemical plants, and retail stores all across the world. And if you've ever filled up for gas at an Esso or a Mobil station across the world, you've definitely contributed to Exxon Mobil's revenues, which reached a staggering $279 billion in 2018 alone. So now that we all have a general idea of what this company does, let's take a look at their past performance. As expected, what we find is a long track record of growth, but over recent years in particular, the stock has actually continued to plunge from its all-time highs in 2014 of just over $100 per share. But of course, for any value or dividend investor out there, this just presents a better buying opportunity at these low levels. So taking a look at some of their valuation measures, we find that the company is trading at a current PE ratio of 20 and a forward PE ratio of 19. And although it doesn't seem like the PE ratios are too cheap right now, it is providing some good value when compared to its historical prices. Now, if we jump into the dividend itself, we can find that they have a forward annual dividend yield of 5.1%, which is absolutely ridiculous. It's definitely a great yield. Now, to add a little bit of pepper in with that sweetness, the dividend payout ratio is unfortunately 98%, so that means that the company is essentially paying out all of their earnings in dividends. And that is most likely caused by their earnings dropping over 40% in the most recent quarter, likely caused by the oil prices not being too high, along with many capital expenditures the company had to deal with. But it should be noted that the earnings of oil and gas companies fluctuate up and down quite drastically, and the best way to analyze an oil and gas company is on a free cash flow basis. And taking a look at their free cash flow, it really didn't drop a whole lot in 2019 in the most recent quarter, so I think the company should be fairly stable over the long term. Now, it should also be noted that Exxon Mobil has been paying and increasing this dividend for 37 consecutive years, which is quite mind-boggling, and this actually makes them a dividend aristocrat. And on average, the growth of that dividend over those 37 years was about 6.2% on average, so it's definitely growing at a fairly healthy rate. But the question is, would I buy Exxon Mobil right now? I would personally start a small position in this company to be able to take advantage of that sweet, sweet dividend, because the company has been dropping over the past 5 years, and I really don't see oil and gas going anywhere in the near term. Along with that, Exxon Mobil is an industry leader and one of the biggest oil and gas companies in the world, so I can't see that dividend being cut anytime soon, and I think it's going to be fairly safe, at least over the near term. Alright guys, jumping into dividend stock number 2 today, and that is Telus Corporation, ticker symbol T.TO. Now, Telus is one of the biggest Canadian telecom companies, and it's essentially equivalent to AT&T, but over here in Canada instead. Now, Telus offers services such as internet, home phone, and home cable to residential as well as commercial customers all across the country. Now, the one thing that I do love about Telus is their recurring revenue business model, because they have 9.2 million wireless customers that are subscribed to their services on a monthly basis. So that means that a company like this has very predictable revenue, and that means that their dividend is a lot safer too. Now, taking a look at their past performance, we find that Telus has performed notably well over the past 10 years and longer, and a company like this sees very little volatility when compared to the broader market, and that's because of the stable business model due to their recurring revenue. Now, over recent years, the stock price has continued to rise, but I do still see a lot of value in this stock given their trailing PE ratio of 17.8 and their forward PE ratio of 16.3. And finally, that brings us to Telus's dividend, and their forward annual dividend yield for 2020 is going to be 4.58%, provided they continue paying out that dividend. Now, along with that, their dividend payout ratio is approaching about 77% right now, and that honestly doesn't concern me in the slightest because of their recurring revenue business model, and I know that this company is going to continue being able to pay that dividend. As for their dividend history and growth, the company implemented a program in 2011 to be able to grow their dividend semi-annually at a continued rate, and they've been able to do that for the past 10 years consecutively without any problems. And they also predict that the dividend growth is going to continue all the way through 2022 at a rate of about 7 to 10% per year, which is pretty reassuring for dividend investors. So now the question is, would I buy Telus right now? And the answer is yes, I would buy Telus even though they didn't undergo a dip. This company's not going to see a whole lot of volatility, and I think that right now could be a good buying opportunity with their high starting yield along with their low-ish PE ratio. But who knows, maybe AT&T would be a better bet. You guys will have to let me know if you live in the US. All right, guys, coming in with stock number 3, and that is the Dow Chemical Company, ticker symbol DOW. Now, this company is formerly known as the Dow DuPont Company, which was actually a huge conglomerate and ended up splitting up in 2019 into 3 totally separate companies. And one of those companies, of course, is Dow itself, and it began trading as a standalone company on June 3rd of 2019. So unfortunately, that means that we don't have a whole lot of historical data for Dow, so we'll just have to see how this one rolls, and it might be a little bit more risky. But getting into the business model, the company is very focused on commodity chemical production, such as polyethylene, silicone, and paint additives, among other products. And the way that I see it is that products like this are always going to be in demand. There's always going to be a market for paint, for polyethylene and plastics of all sorts. So even if oil and gas doesn't go too well, I think Dow is still going to hold up. Now, taking a look at their valuation measures, we find that Dow has a current PE ratio of 21.5 and then a forward PE ratio of 13.1. So that actually signifies quite a bit of growth coming in the next year. But the best part here about this company is actually the dividend, and they have a forward annual dividend yield of 5.4% right now, which is absolutely ridiculous. I love that. And along with that, on Yahoo Finance, I found that their payout ratio is only a mere 39%. I don't know if this information is fully correct, so you guys have to check this for me and let me know as a sanity check. But unfortunately, as I mentioned before, there isn't a whole lot of history just for this company alone. Most of the history was in Dow DuPont itself, so we don't have a historical dividend or if they've been increasing their dividend over time. So it could be that this dividend just stays flat over the years and stays at this type of a yield. So I'll definitely be doing a lot more research into this company and considering it as a future potential investment. Alrighty guys, jumping into dividend stock number 4, and that is the Toronto Dominion Bank over here in Canada with ticker symbol TD.TO. Now, you guys know how much I love Canadian bank stocks, so don't hate on this video, but I do want to share this one stock pick with you. TD is the second largest bank over here in Canada in terms of market capitalization, and over recent years, it's been one of the top performers among the Canadian banks. And what differentiates TD among all of the other Canadian banks that I've spoke about before is that TD has a lot of US exposure. And over recent years, that's allowed TD to propel its earnings growth a lot faster than some of the other Canadian banks out there. So taking a look at their valuation measures, we find that the company is at a PE ratio of 11.9 right now, and then a forward PE ratio of 10.1. So this is definitely a good sign that analysts think that the company is going to continue growing their earnings over the next year, and it is a fairly modest growth rate for a bank itself. Now, getting into the dividend, we find that TD has a forward annual dividend of 4%, and then its payout ratio is only 46%. Now, this just means that the company is paying out less than half of its earnings in dividends, so it's very sustainable over the long term to maintain this 4% yield. Furthermore, TD has been paying and growing this dividend ever since 2011, so it's been about 9 years, but it should be noted that they didn't even cut their dividend in the Great Recession. They just kept it constant for about 2 or 3 years. And finally, we find that their average dividend growth rate has been in the double digits at 10% per year for the past 5 years. So it's definitely growing at a very quick rate, and they can keep increasing it as long as they have exposure in the US and keep growing those earnings. So this is actually a stock that I've been looking at for a long time now. I'd definitely love to buy into TD, but it's really hard to find a discount. Right now they are on about a 5% dip, so I might start a little position, but we'll see how it goes. All right guys, getting into the last dividend stock today, the fifth one that I have on my list, and that is ATCO, ticker symbol ACO.X. Now this is actually one of the leading utility companies in North America, which operates in Latin America, the United States, Australia, and of course Canada. In fact, I actually use ATCO for my electrical and gas services over here in northern Alberta, Canada. I'm not saying that it's a really good deal being with them, but you do get some good customer service. Now, since ATCO is a leader in the utility industry, they do have very stable income, having highly contracted as well as highly regulated income. But although they do have very stable income, there is still a little bit of risk in this stock because of the variation in natural gas prices along with electrical prices. And so that's why you see the volatility in the stock price that I'm about to show you. Historically, the company has done very well, as you can see from the all-time chart, but over recent years it has been up and down, and I think that right now it is providing some pretty good value. Currently, their PE ratio is only 10.4, along with their forward PE ratio being 17. It does show a decline in earnings there, but that is because of the variation in natural gas prices, I would definitely assume. But then also taking a look at their price to book ratio, we find that it's 1.48, and so anything below 1.5 for a price to book ratio, in my opinion, is a pretty good deal. And of course, getting into their dividend, we find that their forward annual dividend yield is 3.4, which is pretty good, and then they have a payout ratio of 32%. Now, although their dividend yield really isn't the highest out of the group we've seen today, their dividend payout ratio being so low definitely compensates for that. And then of course, since the company has such stable income, it's been able to continue paying this dividend over the past 26 years consecutively, along with growing it every single year over those 26 years. And since they did pass that 25-year mark 1 year ago, they are considered a dividend aristocrat, which is very good status to obtain. Now finally guys, it's not only how long the company pays the dividend, which is important, but also how fast they grow that dividend. And in ATCO's case, we find that over the past 10 years, it's been an average growth rate of about 13% per year, which is really good. So overall, my thoughts on the company are that it's a very good and stable company that will continue to do well over the long term because of this stable and regulated income. And I don't believe I own any utility companies in my portfolio right now, so this could be a first buy coming up in the near future. Anyways, that is all I have for you today. If you did stick around until the end, definitely let me know in the comments down below what you thought about these dividend stocks and what your favorites are of the bunch. And if I did miss any good dividend stocks on sale at the moment, definitely let me know as well, because I would love to research them on my own and then possibly make a video about them. But anyways, thanks for watching the video. If you did enjoy, make sure to smash that like button for the YouTube algorithm. And then if you haven't already, definitely consider subscribing for more content on personal finance, business, and investing in the near future. And I'll see y'all next time.